This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money and Markets podcast. We've actually got a special one today. We're going to be talking about the spring statement and everything that was announced by Rachel Reeves and what it means for your money. So I'm Dan Coatsworth. Joining me is Laura Suter and Charlene Young.
Hi Dan.
So Laura, let's start things off with the OBR forecasts. I think ahead of the event, people were expecting the OBR to come out with some very gloomy stuff. We certainly got short-term shock, but longer-term perhaps wasn't as bad as people thought.
Yeah, there's definitely, as you say, short-term pessimism, longer-term, maybe slightly rosier outlook. So the first thing that everyone's really focused on is GDP growth. We saw the forecast for that halved to 1% for this year, down from a 2% estimate that was put out after the October budget. And this is really the kind of headwind that Rachel Reeves was facing as she went into this, was how to deal with that lower forecast and also how to balance the books based on her very strict rules that she's imposed on herself. But that GDP growth is going to pick up, like you say, and it's going to average 1.75% over the rest of the decade. So a pickup, but still we're not talking huge, amazing growth there, are we?
No, I mean, I think there was so much leaked ahead of the event. We knew that the OBR was going to come out and say, like, we're halving our forecast for this year. But I think I don't know whether you can say, is it impressive that we're seeing sort of a steadier growth thereafter? I guess when expectations were so low, this does feel like there's a slight hint of positivity, but of course the key thing here, these are forecasts, aren't they? And I guess economists and forecasts not always reliable.
And I think the fact that they've even changed quite dramatically from just October, which isn't even that long ago, highlights how volatile they can be. And actually the OBR itself flags lots of potential risks to the forecast. So the most key ones of those are if the recovery that they expect in UK productivity growth fails to materialise, that will obviously have an impact on GDP. Also referenced the global trade disputes escalating. So if we do see more meaningful tariffs come in, then that will have an impact. And actually, it says that trade war increasing those tariffs could reduce UK GDP by 1%. So that a huge potential impact, and then other risks coming from, if the interest rates don't drop by as much, if gilt yield expectations change. So yes, it's a forecast, but also it's based on lots of things that could change at what is quite a volatile time for a lot of those factors.
I think, the trade war stuff is really interesting because, from the UK perspective, we still don't really know what Donald Trump is actually going to do beyond certain metals is the only thing that seems to be agreed so far. So I think that the fact that wasn't really highlighted much in the speech, was it? That was in the actual documents that were produced afterwards. And to me, it's like, is that the way to do things? I thought we were meant to be having an open, transparent new government, and that certainly suggests that they were trying to hide that one under the carpet.
Yeah, and I think there's a lot of fine print when you go through these documents that isn't included in the speech. And of course, they want to lead on some of the more positive factors. So one of the headline things to come out of the speech is that the government claiming that people are going to be on average £500 a year better off. The small print here being by the end of the Parliament, so by 2029. So yes, that's great news. Their disposable income is going to grow, but you've got to wait quite a long time for that £500 a year. And that's obviously a theoretical amount. It will depend on your own circumstances as to how much personally you might be better off, but that's the average. So I think it is a case of some good news headlines, but then really, as always with these things, digging into the detail to find out what the time frame is, what that means, and what risk factors there are to that.
I think with the OBR inflation forecasts are very important, I think, to literally anyone listening to this podcast now. This year inflation is going to potentially jump, but from 2027 it will hit the Bank of England's 2% target. So Charlene, why is these OBR forecasts important? Because they clearly feed into lots of other things which relates to all of the way which we our money and personal finances.
Yeah, so I think it's kind of important to think about why the Chancellor is standing up and talking about these OBR forecasts. Why are they important? And I think we cast our minds back to the mini budget of 2023, where the OBR was effectively shut out from that kind of decision-making process and the preview. And we saw the chaos and the lack of the confidence in the measures that were announced then, obviously most of which didn't come to light, but we still are feeling the effects now. Now, these estimates don't necessarily feed into how things like the state pension, benefits and mortgages might be affected by price rises. But it does feed through to what the OBR thinks is going to be the cost of servicing that government debt, so the interest the government is paying on the massive debt pile, I should say. And again, that magic word of headroom. How much headroom, fiscal headroom, does Rachel Reeves has with those rules that she really doubled down and committed to? Again, absolutely saying that they were non-negotiable. And it does feed through to the fact that we haven't seen any tax rises announced. And as Laura mentioned, that kind of £500 extra disposable income by 2029, I think that coincides quite nicely with the hope that tax thresholds will begin to start to increase, and we'll see the end of this big freeze and the effects of fiscal drag.
We're going to be talking a little bit about different parts of your personal finances stuff. It's probably worth talking about what actually the Spring Statement has done to your money today. As you're listening to this, I mean, the market reaction was quite telling. Laura, I don't know if you were keeping your close eye on gilt yields on your pound chart. Probably not.
I tend to leave that side to you.
Yeah. But we saw gilt yields went up during the speech and came back down again. The pound was weak ahead of the announcement, and then it sort of ticked back up slightly again. This is versus the US dollar. Stock market's a little wobble, but not really. I mean, so really, as we're recording this, I mean, it's an hour after the event has just taken past. There is literally no change, to where things were. I think I would take that as a win, because there was a potential for this event to trouble people. There's so many unknowns at the moment in the world, whether that's to do with geopolitics, economic stuff, not just the UK, but globally. It doesn't take much to upset the market and sort of the broader investment community. So I think the stability is probably quite good. Talking a lot about house building and defence being key industries that will help to drive economic growth. On the sort of house building side, there's a big push to create lots of new jobs, training up skilled people, which is, this is really, really encouraging longer term for future generations. But does that imply perhaps they haven't got enough people today to do this work? So I don't know. And then defence side of things is, this has been well flagged that the UK will spend more money on defence. They're saying that it's a very uncertain world. I guess there's been a bit of pressure from Donald Trump on lots of countries in Europe to, you've got to spend more here. So really, there's not really any sort of new news from sort of these industries. Everyone knew that there were going to be lots of activity. But what's Rachel Reeves actually how's she going to balance her books? Obviously, she's saying that there was the potential of if she hadn't done anything, her plans would have gone off the rails. But that's kind of what she implied, wasn't it? But Charlene, what's she actually come out with to say? How is she going to sort of find more ways to save money and gets more income into the government?
Yeah, so we've seen obviously that jump in defence spending that you've mentioned, but that will come at a cost to the overseas aid budget. And we've also seen measures to tackle what's been referred to as, the bill for benefits or the bill for welfare. So kind of a freeze on elements of universal credit, a cut, and then a freeze on elements of universal credit, trying to get people back into work, trying to support people who want to get back into work to do so. And there's a pretty stark figure in there. I think it's 1 in 8 young people are what we call NEETs, so not in education or employment. There's a huge untapped resource there. If people trying to upskill and improve their earnings prospects, but also have that feed through to the economy. We've also seen kind of building on what was already announced in the October budget in terms of cracking down on tax evasion, which does come up at every single budget, whatever government we're talking about. More money for an extra 500 compliance staff. So here it's all about tackling the tax gap, which, according to the documents in the fine print, stands at a massive £44 billion. So the tax gap is that difference between the amount of tax HMRC thinks it should be getting in and actually what's coming through the door. So really kind of doubling down on that, trying to recoup some of that lost tax, and also confirmation that we're going to get this whistleblowing scheme, which is actually something that we do want to import from the United States and Canada. People who are whistleblowing on tax evasion potentially getting a percentage share of the money that's brought in through the door. So, whilst we haven't seen tax rises, we all know what's coming in April. There are measures there to try and balance these books.
Shall we talk about some of the key areas of personal finance that perhaps we were expecting, but we didn't get anything today, but what might still be coming down the line? So, Laura, should we start with pensions? I guess, were we expecting changes to the triple lock, or even that to be put onto the agenda to be reviewed again, or is that just simply something that the media were looking to write about, trying to come up with new ideas?
It's that tricky one that no government really wants to tackle. So the triple lock is the measure by which the state pension rises every year. It's linked to either a figure for wage growth, a figure for inflation, or a flat 2.5% if those other figures are below that. And essentially, it's a good boost for those on the state pension. It means that their state pension continues to rise. That is essentially their income, and for some people it is a huge bulk of their income. It means that that continues to rise each year as prices rise and wages rise, but it costs the government a lot of money. And there's been some talk pretty much ahead of most budgets about what's going to happen to the triple lock. Is it going to be downgraded to just a double lock and based on two of those measures? Is it going to be entirely reformed? But of course, there's a huge number of people in the UK that are on the state pension or about to fall onto the state pension. And so you really risk annoying those people who are voters if you decide to completely reform it and downgrade how much it increases by each year. We obviously saw at the last budget, Rachel Reeves took away the winter fuel allowance for a lot of pensioners. So it was highly unlikely ahead of this that she was going to then make a very unpopular move to downgrade the amount that state pension increases by each year. But it's the same thing that we talk about at a lot of budgets. It's a rising bill that isn't going anywhere and at some point needs to be tackled, but it's just a very tricky one for the government to tackle.
Well, if they don't change the triple lock system, could we ever see a situation where they do means testing? If you already have significant assets, should you get less of a state pension than someone who doesn't have that? I mean, that does seem like it could actually cost the government more money to do that means testing than it would save.
Yeah, and you get to the issue of, like you say, does the administration of the thing end up costing more than you're saving through that? But I mean, I guess we've seen a step in that direction with the change to the winter fuel allowance, in that was then, rather than being handed out to every person, whether they've got millions of pounds in the bank or whether they're entirely reliant on benefits, that has now been reduced to a smaller group of people. But it's again just very difficult. If you change that, you would have to have quite a long lead time to any big changes to the state pension, because people will have planned their retirement around having that income. So again, I feel like, I don't want to be pessimistic, but I feel like it's one where they're just going to kick the can down the road and hope that a future government solves that big problem.
Yeah, and there's lots of talk about, voting for change, but just not that one, I think.
And not the really tricky ones.
And actually, we are still less than 10 years into the new state pension system as well. So, in kind of pensions talk, that's still relatively short term, I think. But yeah.
What about cash ISAs? Now, this was a real hot potato leading up to the spring statement. I think that there was, tentative signs that the government wanted to sort of take a look, potentially reduce the allowance on it, and then seemed to play down the speculation that we'd get anything at today's spring statement. But is there something coming around the corner? Charlene, what do you reckon? Because obviously that was referenced in the documents, wasn't it?
It was, yeah. So kind of buried right in the middle of those documents was a couple of lines on something called targeted support, which is an initiative to help people feel confident investing, tied into ways in which the government could maybe use ISAs, individual savings accounts, and their tax-free benefits to get more people invested and get the potential benefits of returns from investing. So whilst we haven't seen a formal consultation, the government said it's going to continue to consult with stakeholders, we could see a move, where providers are able to continue to help people, give them the guidance and reassurance they need to take that first step into investing. But like I say, no kind of cuts to the allowances or anything like that, because we've discussed it before on the podcast. Just cutting an element of the allowance just does not kind of tie in with ISA simplification, which, although not mentioned today, is something that the government has previously committed to. It's not going to automatically get more people to invest. So I think we're pleased to see that there's no more complications to ISAs, certainly no cutting of the allowances, and also moves to help more people invest who perhaps aren't already.
So I think maybe something to come at the next budget this autumn. We might get something on it. I mean, if we do have a reduced allowance, and there's as an incentive to get you to invest more in the UK, it's probably just reminding of people who listen to this podcast. A lot of the companies in the UK, on the UK stock market, they earn all their money overseas. It's not a play on the UK economy. You could look at the FTSE 250 index. There's a bit more representation, but even that only half the companies there. Obviously, Rachel Reeves wants people to invest more in the UK companies to help drive the economy, but it's never a simple thing of that. If you lower the allowance on cash ISAs, it's not going to magically create this big wave of interest in UK shares. But I think perhaps that's a big topic we can delve in on another podcast. But so let's talk taxes then. So she clearly said from the start, I'm not going to fiddle with the tax system. But of course, we've got this issue where frozen allowances, fiscal drag. Laura, what's that in plain English then? So.
I've got a great fact for you guys. Do you want it? Good. I wanted more enthusiasm there, but that's fine. The UK's tax share, which is how much HMRC brings in compared to the size of the overall economy, is forecast to hit its highest level since the end of World War II, according to ABR predictions. And so I think that highlights that while Rachel Reeves and her government pledged no increases to national insurance for employees, income tax and VAT, we are still seeing a huge rise in the tax take. Now, part of this is because national insurance has risen for employers, and part of it is because of those frozen tax bands that Charlene talked about earlier that mean that all of us are paying more tax than we would have otherwise been doing so had those tax bands increased with inflation. And so, yes, the headline is we haven't raised taxes, but actually if you delve into the figures, we're all paying more tax than we would have otherwise been, which to me, I would call an increase in taxes, but semantics, I guess.
Yeah, going back to tax rises, we did see one personal tax go up in the budget, and that was the rate of capital gains tax. And I think there was a really interesting stat in there that the kind of revised potential tax take from that rise has actually been cut quite dramatically. And I think that illustrates, tax rises don't always work, especially when it comes to things like capital gains. There's that kind of sweet spot where, if people can afford to hold on to those investments that are holding those gains, they might just do that, and that might account for that lower predicted tax take.
So things like gifting rules, which is at the moment, if you can give someone some money and as long as you don't die within that 7 years, they don't pay inheritance tax. That's correct, isn't it?
Yeah, so everyone's got a £3,000 a year annual allowance, but you can actually make those gifts of any value, and it starts that 7-year clock ticking, as you mentioned, for IHT. And we saw kind of rumours, particularly in the run-up to October, as well as now, that 7-year time frame might be extended to perhaps 10 years or even longer. People are very understandably twitchy about inheritance tax. The death tax, despite the fact not everybody will pay it or not everyone's beneficiaries will. But yes, we've not seen, anything, any movement on IHT, nor any kind of commentary on what might be happening following the closure of the consultation on bringing pensions into IHT also.
So I guess that's another one to watch in the next budget. I mean, if it felt like Spring Statement today, she was finding ways to trim spending, changes to what was being spent on welfare, making the government more efficient, cutbacks there, using technology to improve productivity. But it feels like she walked away in a happy place, but treading a very thin line. So come the budget, it feels inevitable that she's going to have to make some changes, unless we suddenly get this dramatic increase in the economy. And I think she made a point right at the end saying there's no quick fixes. It will take time for reforms to feed through to the everyday economy. So, so I guess it'll give us lots of things to talk about in a few months' time.
Yeah, I thought it was interesting that she went into this spring statement very firmly calling it a spring statement or a spring forecast, not a budget. And she went into it saying that there weren't going to be any huge policy announcements and changes to tax. And actually that has broadly materialised, which I think some of us who've been covering budgets for a while were maybe a little cynical that might not happen. But I think what it does mean is if you've only got one announcement per year, one true budget per year, where you can talk about tax changes or those really big changes to spending plans or cuts, then those are going to be bigger events, like you say, Dan. But I thought it would be maybe useful to talk about anything that you found in the nitty-gritty detail that you thought might be interesting, that people might have missed or you thought was particularly key. I'm putting you on the spot here now. Dan, do you want to go first?
Sure. I mean, the one thing that really did surprise me was OBR's increased forecast from next year for the economy, like every year from next year. I honestly did not see that coming. I felt like there was so much negativity in the news at the moment about what's going on that Rachel Reeves last October came out with this budget, increased costs for businesses. That's led to lots of businesses going, well, we need to think twice about the investment we're going to do. You've seen cracks in the jobs market. You've seen consumer confidence has been knocked. And so to me, it's like, I thought it was like just setting us up for what's going to be a difficult year. And I guess the OBR downgrade for this year confirms that. But it's that bounce back from next year. And Laura, you said at the start, they're not amazing, blow away forecasts, but it's just the fact that they're better than they previously thought. I think you have to take that as a big positive.
Charlene?
I'm gonna stick with tax, I think. So I mentioned that kind of increased spending on compliance. There will also be from April this year coming to bite for most people on April 26, higher penalties if you are late filing your tax return and late paying that tax bill. Now this is all part of like a move to making tax digital. So any small business owners that are listening will be maybe very familiar with this for VAT. So that is already currently in place. If you're a small business owner, you will be on this new system. It's gradually moving across for self-assessment for income tax. So some of us will become very familiar with it in the future, but those penalties for not paying your tax on time are going to potentially rocket. And I think that's quite interesting given, I've written a lot about service issues with HMRC, anyone who's tried to get through on the phone, and being faced with hour-plus hold times, myself included. So we've seen investment in HMRC absolutely plummet, and now suddenly we're getting this kind of huge injection of cash to get these compliance officers to possibly fund this whistleblowing scheme, and maybe also funded by higher penalties.
Laura, what about you then?
So one interesting thing I spotted was a change to child benefit. So you start to lose child benefit once you earn a certain amount, and then it gets whittled away until you reach another threshold. The boundaries for that were changed recently, but one thing, it's a kind of nitty-gritty admin point, but it will help a lot of working parents, which is that if you end up getting too much child benefit and you need to repay it, you'll now be able to repay that through your tax code, so through your normal PAYE pay. Previously, you would have had to have filed a self-assessment tax return, even if that's the only reason that you needed to file that self-assessment for. And so it takes away the need to do that annoying admin of filing that self-assessment return and making sure that you file it by the deadline and declaring that information. This is, it's a bit of a win for working parents who are caught in this tax trap, but it's part of the government's broader move to try and reduce the number of people that need to file self-assessment. We also saw a change to the trading allowance, which is the amount of money that you can earn from a kind of side hustle job, we saw the threshold for that change in terms of whether you need to file a self-assessment tax return for that or not. So I think what we're seeing is, like Charlene said, HMRC has been really under the cosh of this rising number of taxpayers, rising number of people filing self-assessment tax returns, and then lo and behold, obviously needing help with that and calling the helplines. And they're really trying to try and push back on the number of people that actually need to file that self-assessment. And I think any reduction in form filling has got to be a good thing.
Excellent. Well, that's everything from us this week. So thank you very much for listening to this special on the Spring Statement. We'll be back next week with the normal format of the podcast. We'll have some brilliant guests. We're going to keep top secret for now. But until then, thanks very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.